In the past year, numerous news outlets have extensively covered the topic of China's economic decline. In recent months, Western media has particularly highlighted the slowdown in China's economy attributed to challenges in its property sector. While it is accurate that the Chinese property market is experiencing a deceleration, we remain unconvinced that it will suffer a collapse comparable to the 2008 subprime crisis in the United States. Certain pundits have drawn parallels between China's property crisis and the Lehman Brothers bankruptcy in 2008, a pivotal event during the subprime mortgage crisis. Notably, major Chinese property developers like Country Garden and Evergrande Group are confronting difficulties, but likening them to Lehman Brothers is an oversimplification. In this video, we will delve into why China's property sector is unlikely to collapse and why it won't exert a detrimental impact on the broader Chinese economy. Before we delve into the details, consider subscribing to our channel to receive more engaging videos like this one. Now let's explore the reasons behind our assertion that a complete economic collapse in China is improbable. China possesses substantial policy leeway to tackle present economic issues. The U.S. Treasury Secretary Dr. Janet Yellen recently shared with reporters, "We see China's growth as slowing over time. That said, China has quite a bit of policy space to address these challenges." Such forthright comments from the U.S. Treasury Secretary carry significance, particularly when prevailing Western media sentiments tend towards a pessimistic outlook on China's economic landscape. Consequently, her statement has drawn global attention. Yellen's assessment holds validity. China's policy latitude surpasses that of other major economies, a fact often underestimated by many observers of China's economic trends. In the realm of monetary policy, China adopts a more cautious stance compared to the Western world. Currently, the West faces constraints on further monetary easing and is compelled to counter ongoing inflation by consistently tightening, primarily through increasing interest rates. In contrast, China is not contending with inflationary pressures. Its consumer price index remains stable, and its producer price index consistently registers negative figures. This situation provides China with substantial flexibility in its monetary policy, enabling the possibility of interest rate cuts and reductions in the reserve requirement ratio, or RR, for banks. The RR represents the percentage of deposits that banks must maintain with the central bank. This is a luxury not available to Western economies, where the RRR has largely hovered around zero. The reserve requirement ratio is essentially the portion of customers' deposits that banks must keep in reserve with the central bank. It acts as a safety net, ensuring that banks always have a certain amount of funds available to cover withdrawals or unexpected economic challenges. For instance, during the pandemic, Malaysia's central bank, Bank Negara Malaysia, announced a 100 basis point cut in the statutory reserve requirement ratio from 3% to 2%. This measure released approximately 30 billion ringgit worth of liquidity into the banking system, allowing banks to have more funds during the lockdown period. It also served as a catalyst to stimulate the country's economy during challenging times. On the other hand, China's current required reserve ratio is set at 7.4%, significantly higher than many other countries worldwide. In comparison, the United States has a 0 RRR, and Japan's RRR is less than 1%. This indicates that China has ample room to inject cash into the economy through its monetary policy via the banking system. A reduction in China's required reserve ratio would release more money into the market, further stimulating the economy. China's robust fiscal policy and favorable financial position. In terms of financial health, China stands out positively compared to many other countries globally. The nation's financial balance sheet reflects a positive net worth, a contrast to countries like the United States, Japan, and Germany, which find themselves deep in negative territory. Global analysts have extensively discussed China's government debt, often a point of concern. How much debt does the Chinese government actually hold? Not a substantial amount. The ratio of central government debt or sovereign debt to GDP is a mere 21%, the lowest among the major economies worldwide. According to estimates from the International Monetary Fund, even when factoring in all local government debts, including hidden liabilities, China's overall general government debt level is only around 110% of GDP. In comparison, the US public debt ratio is approximately 140%, and Japan's stands at a staggering 260%. Therefore, China maintains a relatively low debt ratio. Moreover, assessing financial well-being involves considering both liabilities and assets. Analogous to an individual who takes out a loan to buy a home but may still be wealthier due to asset ownership, nations must be evaluated through a comprehensive lens. What distinguishes China is the extensive ownership of state-owned enterprise assets by the Chinese government. Additionally, all of China's natural resources, encompassing land, minerals, rivers, forests, mountains, grasslands, and more, are state-owned, constituting a substantial asset. In contrast, countries like the US and Japan possess minimal state-owned equity, with the majority of resources privately held. The portion that the government can control is relatively small. Hence, China's fiscal position stands notably healthier than that of other major economies. The stability of China's banking system and real estate sector. Is the downturn in the real estate market in China poised to trigger a financial crisis akin to the 2008 events in the United States and Europe? Many commentators have sounded alarms, labeling the challenges faced by the troubled property developer Evergrande as China's Lehman moment, drawing parallels to the collapse of the esteemed American bank that catalyzed the 2008 financial crisis. However, the answer is a resounding no. In China's major cities, the average loan-to-value ratio of mortgages hovers around 40%, implying that housing prices would need to drop by more than half to result in negative equity for homeowners where the value of their house is less than the money they owe on it. Such a scenario is highly improbable. Here's a simple example. Suppose a homeowner in Beijing has a property valued at $500,000. With an average loan-to-value ratio of 40%, the homeowner has a mortgage loan of $200,000. Even if housing prices were to drop by half, reducing the property's value to just $250,000, the homeowner's equity would still be $50,000. This example illustrates how the 40% loan-to-value ratio provides a considerable buffer against negative equity, making it less likely for homeowners to face financial distress even in a declining real estate market. Additionally, unlike in the United States, Chinese homeowners cannot simply abandon their mortgages if such a situation were to occur. In mainland China, as well as in Hong Kong and Australia, mortgages carry unlimited personal liabilities. This setup was evident during the 1997 Asian financial crisis, where Hong Kong's housing sector experienced negative equity, yet no banks faced failure. Contrary to the worry of a financial crisis, the Chinese banking system faces an opposite challenge: excessive cash from prepaid mortgages and above-average savings. Since 2022, prepaid mortgages constitute 12% of all mortgages in the banking system. Household savings surged by $2.5 trillion in 2022 and $1.6 trillion in the first half of this year, surpassing normal levels. Residual loans to property developers make up less than 6% of the loan book in the banking system, and all these loans are secured by collaterals. Chinese banks exhibit robust capitalization, boasting an average capital adequacy ratio exceeding 15%, with an average non-performing loan ratio of approximately 1.6%. While non-performing loans have seen an uptick in recent years, banks are promptly selling or writing them off due to China's regulatory requirement, demanding reserves covering non-performing loans exceeding 100%, a threshold surpassing any other country globally. Consequently, holding on to non-performing loans is deemed unworthy for Chinese banks. To sum up, we maintain the perspective that China's economy is not in a state of collapse. With its robust financial net worth and considerable policy leeway for the central government to enact adjustments, China is well positioned to navigate the current challenges in the property sector. Additionally, it's noteworthy that real estate directly contributes to only around 11% of the entire GDP, further highlighting the diversified nature of China's economic landscape. We've been presented with the narrative that China is on the verge of collapse, ready to pull the rest of the world down with it. However, we've witnessed this storyline before, and we're familiar with its conclusion. Contrary to predictions, China's economy isn't teetering on the edge of collapse. Despite a slowdown in the property sector, other industries are on the rise. So what's your take? Do you believe China is on the brink of an economic crisis, or will it sustain its growth in the future? Share your thoughts in the comments below. If you find this video informative, show your support by hitting the like button. Most importantly, subscribe to our channel to ensure you receive more engaging videos like this one in the future.